So, in the video I shot yesterday, I covered the Federal Reserve's latest FOMC meeting and what it meant towards your 401k. I talked about the latest rate hike, where they might be going in the near future, the foresight of the economy so far, what they're projecting, and how all of that contributes to where your 401k is currently. And I also dropped a strategy and some suggestions on how you can salvage and preserve your 401k through these rough and uncertain times. This video is going to be a part 2 that's going to explain the other side of the coin, where the Federal Reserve may be pivoting sometime this year, not only pausing rate hikes, but possibly cutting rates. If that happens, we're going to talk about what that looks like for the economy, the investment markets, and thus your 401k. This is JP from Blueprint for Prosperity, helping you to increase your net worth through relationship banking, maximizing your borrowing capacity, proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity. So this video is basically going to tailor out what happens if the Fed has to pivot. Many economists, financial pundits, and analysts are certain the market is literally pricing in that the Federal Reserve is going to have to cut rates before this year is out. Many are saying they'll have to pause in their next meeting. Many are even leaning that they'll have to cut as soon as May or July. If this were true, if this were to happen, what happens to the economy? What happens to the investment markets? And what happens to your 401k in the process? The Federal Reserve's policy has been that inflation is primary over all other potential challenges or cracks in the system. They're now being contested by what's going on in the banking industry and its fragility. The fact that it's fragile and that higher interest rates are pressing on the banking system, especially medium and smaller banks, is threatening a systemic risk that the Federal Reserve and the government overall is just not willing to contend with. So the Federal Reserve has already shifted its language around just a few reasonable sized banks collapsing in the last 2 weeks or so. They've already gone from guaranteeing more rate hikes to fight inflation more aggressively to moderating the concept or leaving flexibility that they will have to raise more rates, because their silver lining out of these banking collapses is that the lending sector in the banking system will have to tighten for banks to better secure themselves. And that in itself pulls money out of the system and works against inflation. It has similar or almost synonymous effects as rate hikes. So the Federal Reserve is thinking, well, if this is the potential outcome of this situation, we might be able to sit back, flatten out our rate hikes, pause where we are, pause the terminal rate, and let the tightening in the banking system do the work for us. That's what they're sitting back and observing, and that's what they're hoping is going to happen. If the Federal Reserve gets data that the economy is more fragile than projected, and or banks start to collapse, there's a bit of a cascading effect of banks starting to collapse, then this could force a Fed pivot. This is what many economists and pundits are screaming from the rooftops at the moment, is that the Federal Reserve is data-driven, and that a lot of banks and a lot of different, economic factors are more fragile than they're expecting or projecting. This being in reality, that would mean that the Federal Reserve could be forced to cut rates in the coming meetings sometime before this year is out. If the Federal Reserve cuts rates, your 401k potentially could go through the roof. And here's why. The Federal Reserve's Fed's funds rate basically controls the money that the lending between the Federal Reserve and the banking system. If that rate drops, the first thing that happens is bonds are typically inversely correlated to interest rates, meaning that if rates are going down, like if the Fed cuts, that bond prices and the bond yields rather could go up. That's the first thing. So if your 401k portfolio is conservative, if you're closer to retirement right now, that means that you're likely deeply invested in bonds. And your portfolio could increase or go up because bonds are inversely correlated to interest rates on average. It's not an exact science, but that's typically the case. The next thing that could happen is this is going to put more liquidity back in the system because money's going to be cheaper. If money is cheaper, then now stocks, many stocks, because the businesses that make up the stock market are going to have access to more capital and liquidity again. That means that these businesses are going to have the fuel they need to grow. If that happens, their earnings could go through the roof. What happens when their earnings go through the roof? The stock valuations go through the roof. And that means your 401k could go through the roof, especially if you're, further out from retirement and you're, better than 60, 70, or 80% invested in stocks in your 401k. So real estate, particularly residential, but even commercial, which is taking a beating right now, by the way. I'm going to cover a video on that soon. Residential real estate could go crazy because inventory is short. And with the inventory short, that means pricing hasn't really come down. And those who can't afford to buy are already in a highly competitive market because there's not enough property out there. You drop interest rates, that means the mortgage the mortgage rates are likely going to come down with it. If the mortgage rates come down, that puts more buyers in the market. And we have a 2021, early 2022 scenario all over again. It's going to be chaos because you're going to have a bunch of people that can afford houses that aren't on the market. Commercial real estate could also get a break because that puts more liquidity back in the system for them. It can induce further investments and allow banks to put more loans out. And this could re-strengthen the banking system, and it could re-strengthen or at least put some breath back in the commercial markets, which have taken a real beating since COVID. Your 401k could see a massive benefit from rate cuts. And that may sound great if you are steeply invested in your 401k. But the problem is the overall economy could be in extreme danger if the Fed has to cut rates before it can wrangle in the current inflation issues that are already out there. Inflation is still currently, as of last data, at 6%. It's probably going to be lower than that by the time it comes in again in the next month or so. But it's still likely going to be well above 5%. And that's with the Federal Reserve compressing rates for almost a year straight now. If they are forced to pivot and cut rates, inflation could go absolutely bananas. It will take a bath in these economic circumstances because that means more liquidity is going back into the system. Borrowing is going to go back to the roof. Spending already hasn't gone down. The job market is still hot as we speak. If you put lower interest rates into the equation, you're almost certainly going to send inflation through the roof, and the Fed may not be able to get it back under control. So yes, your 401k could do phenomenal if rates cut. Overall stock market, bond market, and depending on where you're invested at in real estate, if you own rentals, you can see amazing benefits if the Fed cuts rates. And that's why a lot of people are hoping for it. The side effect that you can't, price in easily is very significant inflation. Very significant. We have some corners of the inflationary basket, the inflation basket, that are already not cooling down with Fed rate hikes. Stuff like certain food items are still going through the roof. The energy sector is still struggling. We're still seeing oil prices go up. If rates get cut, all of this could skyrocket. You could see double-digit gas prices potentially. If you think eggs and milk and stuff like that and beef and all of that costs a grip now, you haven't seen anything if the Fed has to pivot rates this short, this early, while inflation isn't under control. But your 401k could benefit tremendously. If that's the case, I hope the rest of your finances are in order, and I hope that you have the right assets in place to benefit from spiked inflation. And that would be stuff like precious metals, the resource sector, physical assets like real estate, the right companies in stock. Tech could see a major boom. Tech is very dependent on loose credit and a lot of money flowing through the system because it's dependent on credit and lending for growth. So tech could go back through the roof. It's going to be wild if the Fed has to cut rates. But I wanted to give you an indicator of where your 401k can go, and that's what this video is about. I know this was valuable information for you. I'm going to continue to cover this live. As you can see, I'm shooting this stuff off the cuff because there's a lot to cover, and I want you guys to know how to move in this crazy, tumultuous stock market and economy and real estate market that we're in, investment market overall. Thank y'all for tuning in. I enjoy bringing you this content. As always, I want y'all to stay focused, stay in motion. I'll see y'all soon.